Distinguished colleagues, ladies and gentlemen, good morning and a very warm welcome to Università Cattolica. I'm really pleased and honored to chair the second special session on this 27th EFMA annual meeting. As you know, the EFMA annual meeting is one of the largest and most prominent academic conferences on finance in Europe, and I'm really grateful to Elena Beccalli and Ettore Croci to have been able to organize this important event at the School of Banking, Finance and Insurance Sciences of our university. It's a great pleasure for me to be chair in this special session on European banking issues, not only as Vice Rector of Università Cattolica, but also as Professor of Banking Law. Discussing European banking issues today also means facing a deep change in the legal framework at European level that started after the financial crisis and is still going on. This is why the issues at stake are particularly interesting and debated, not only from an economic point of view, but also from a legal one. I would immediately like to thank our prestigious speakers from being here. First of all, Ms. Else König, Chair of the Single Resolution Board, who was also President of the German Federal Financial Supervisory Authority, BaFin, until 2015. I also want to thank Giorgio Gobbi, Head of the Financial Stability Directorate of the Bank of Italy, Pierpaolo Montana, Chief Risk Officer at Mediobanca, and Giovanni Pepe, KPMG Partner. I'm absolutely convinced that having the possibility to discuss these issues with such a distinguished panel of speakers will enable us to better understand the present situation and also the future trends. Now let's turn the attention to the topic of this session. It's really wide and gives the possibility to each speaker to approach it highlighting the aspects they think are more relevant. From my point of view, among the numerous legal aspects really crucial for the banking field, I would like to say just a few words related to the latest developments at European level of the so-called banking package. On the 19th of June, the European Parliament's Economic and Monetary Affairs Committee took an important step forward as regards the banking package. As we know, this includes 4 pieces of Commission draft legislation aiming at amending the Bank Recovery and Resolution Directive, the Single Resolution Mechanism Regulation, the Capital Requirements Directive, and the Capital Requirements Regulation. These 4 pieces of draft legislation represent the European Union's transposition of a number of post-financial crisis rules agreed upon at international level. And after some years of their introduction, there is already the need of adjusting them. The context come after months of negotiations and compromise amendments on several technical and political issues, and in particular, less than a month after the Council agreed its general approach on the package. Both institutions, together with the European Commission, will now have to hammer out a common text. These 2 negotiating positions mark an important moment for further progress in the finalization of the banking union. Further risk reduction measures have been politically linked to further risk sharing. First of all, the European Deposit Guarantee Scheme. The former is seen by some key member states as a precondition for the latter. Pressure is building up to revive the dormant, unfortunately, negotiations on the European Deposit Guarantee Scheme draft legislation. But after many months of inactivity, a meeting at the Council Working Group on this guarantee scheme already took place earlier this month. Therefore, I think we are living a particularly important moment for the completion of the banking union, and the session we are here for is definitely up to date. Now, it's time to give the floor to our panelists, and I would therefore ask each of them to address the topic of the conference from their own perspective. The first one is Ms. Elke König. I suppose she, as chair of the Single Resolution Board, is going to focus on topics related to bank resolution. Mrs. König, the floor is yours.
what I intended. Aldi, ladies, gentlemen, is it on or do I need to do anything? Does it work now? I can't eat it. Okay, I will try. Thank you, ladies and gentlemen, fellow panelists. Good morning or buongiorno. La ringrazio per la gentile introduzione. Sono particolarmente contenta di essere a Milano oggi, la città da quale ho bellissimi ricordi di varie visite in passato, ma solamente a turista. Does it work now? No? Okay. Should I take yours? That might be easier. Okay. So, I will just try even closer. So, sono sicura avremo un ottimo dibattito oggi e ora passo all'inglese, è più facile per me. Before I start, I want to thank the organizing committee, in particular Professor Elena Beccari for organizing this and for inviting us to such a wonderful venue. And I will manage with a microphone. I will start to speak about banking resolution, and I'm always worried when talking to a larger audience. Resolution has so many words, but banking resolution actually means how to liquidate a bank without causing a turmoil to the economy, so in ensuring stability to the financial system. So if you want to, we start now the discussion on banking regulation a bit from the end and not from what hopefully is the norm, being the life and healthy work of banking institutions. When the financial crisis hit 10 years ago, not just Europe, all economies, including the US, but also definitely Europe, were very unprepared to deal with the shocks that affected the banking system. And the taxpayer, in the end, was left to foot the bill in lack of alternatives. So it was chosen as a best of the worst of the awful alternatives. A political decision was taken at the G20 level, and the European Union took really decisive steps to better equip itself in the event of a major financial crisis in the future. I'm always starting with this. It's 10 years ago, and sometimes it looks like memories are fading away. So today, I think we can say, to also start with a positive note, we have put many measures in place to ensure that the effects of a shock can be dealt with efficiently and effectively, which should, and I'm very convinced it will, reduce the impact on the real economy and public budgets in case of the failure of a bank. To just also remind you, last year we had our first resolution case in Spain under the SRM regulation. While there is always room for fine-tuning, I think it should not be forgotten that this case, and it was a sizable bank, it was the number 4 or 5, depending how you count, in Spain, was unwound, was resolved without any impact on the real economy. So proof that the framework is working. Also, last year, about actually this week of last year, we dealt with 2 smaller Italian banks, 2 Venetian banks, and in these cases we decided that resolution action was not required and that these by the SRB and the banks were wound up under national law. And I'm happy to answer questions afterwards about the differences. Now, even now, 10 years after the crisis first struck, the banking union is still developing or is not yet completed, and you have kindly already mentioned some of the topics, and I will come back to that in a minute. So, going back to our mandate, I think most people are by far more familiar with the role and the tasks of other EU institutions, but what is the role of the SRB? Where do we fit into the big financial stability jigsaw? At the SRB, our job, our mandate is really to make bank make institutions, to make every bank resolvable, and to put in place plans for a scenario, what if they were to fail. And I'm always saying it's a kind of a plan B or C. It's something that hopefully will not happen to many banks, or if even better, to none of them. But like in any other industry, failing means insolvency, and we should not play around with it. Failing does not mean resurrection. Resolution is basically the alternative to insolvency. And the burden, like in any other industry, should have to be borne by the shareholders, by the creditors, and not by the taxpayer. In other words, when it becomes clear that a bank is no longer viable, the SRB's job is to ensure that there is a plan in place that can see that particular institution closed off without impact or spillover effects on other banks or other sectors of the economy. So how do we do that? Well, you write a plan. By preparing resolution plans for institutions under our remit, and we don't wait, honestly, for an institution to be in trouble. Planning is a very much forward-looking, what-if scenario planning. I was speaking at a macroeconomic conference recently. It's very easy there to say, like macroeconomists, we have a plan, and we have assumptions in the plan, and then sometimes you realize when it comes to executing the plan that the assumptions were not exactly the ones that are now reality. That's also part of our business. So, resolution, or as I sometimes call it, the funeral of a bank, is, if you like, the very last resort. Most of our work, as I said, is forward-looking, addressing topics to make banks truly resolvable, and by that contributing, hopefully, to many banks finding private solutions, addressing their problems, and not coming into resolution. We can't do this alone, and I in particular always emphasize clearly we are working together with the national authorities, which is, in the case of Italy, Banca d'Italia as the National Resolution Authority. They are the ones that know best the specificities of their country and that know best all the laws that apply, because clearly while banking regulation is to a large extent now European harmonized law, well, insolvency law isn't, corporate law isn't, so we have to base all our work on 19 different legal frameworks. But we also can't do the work on our own without the support of the banks. And I think you will all agree, those banking background, it's the banks that know best what are the obstacles to possibly resolving them. So it's for them to come up with plans how to address these obstacles. It's not for the SRB sitting in Brussels to develop a plan what has to be done by Bank A, B, and C. It's more for us to put out the frame, to put out our concern, and then listen to the banks, how they address it, and to assess whether this is a real solution. Just some words on what we have done, what we are working on. At the peak of the crisis, as I said, many banks were considered too big to fail, too interconnected, too complex to fail. There's one good news, and that is there was last year already a study by the European Central Bank saying that the connectedness of banks has decreased. Now this doesn't come as a surprise to experts, because clearly clearing derivatives over CCPs has helped to reduce the interconnectedness of the banks. It has nevertheless created another systemic risk, being the large CCPs. But so to that extent, we can by now be, I think, confident to say that the failure of one large bank would not immediately cause a domino of all the others following suit in this market. And of course, you have all seen the nice calculations that all this legislation that has been put in place is actually positive to the economy in providing more safety. I'm always a bit mindful when citing numbers there. I think they are built a bit on quicksand. So, but basically it should be positive. So what are we doing, or what have we left to do? We have, for now, had the second cycle of resolution planning for the largest banks within the euro area. 2018 will see us putting more flesh to the bones. We will see us in refining resolution plans, addressing more entity-specific topics and not just a group level, and trying to work on this. So this work on resolution planning will continue, will deepen, and I've constantly said this is a marathon, not a sprint, or this is a process and not a product you take off the shelf. So we are focusing on operationalizing the resolution plans to make the banks really resolvable. This includes analytic work on preferred resolution strategies. I don't bore you with all the details. Critical functions, so the question, what function of a bank is really critical for the economy? And just to share with you, when we did a stock take and asked banks to come up with what they believe critical, it was fairly interesting. You had a small bank that had nearly 1,000 critical functions, and you had some very big banks where you would think they are really critical for the economy, saying they've barely found any. Now, we are trying to harmonize that. We have put out now some consideration what we consider critical functions in our context, but there is definitely more discussion needed. And as I already said, there could be quite a number of impediments to resolvability, and they are, to a large extent, very simple. Not simple to address, but simple to understand. Data. If you go into resolution, you need to have immediately on the spot the knowledge of who are the creditors, and not just what is the total amount, but a very detailed breakdown. Now, we do once a year, we request liability data from the banks, and as long as I realize that it takes the banks on average 6-8 weeks and a number of iterations to get it right, I would say it's fairly safe to say data is still an impediment banks have to work on. Because in the case of a resolution, you need them within the next hours and not within the next months. So, and other topics like structure, like, well, I could go on for long, that all these needs to be addressed. And in addition, we need to really work on operationalizing bail-in. If we talk about bail-in replacing bailout, well, then you need to know, how does it work? How does it work in an international banking structure? Do we really have the playbooks for this? So all this will not be just work for us. The banks must play their role here, and they do play their role here, as I said at the outset. And I think I'm always saying this, but I hope that all the bankers will not. I know the banks know very well what needs to be addressed to make themselves resolvable, and they don't have to wait for us to tell them and to send orders out to get their house in order, and I'm seeing a lot of progress also in this field. While the political focus, also when you look at the banking package, seems to be entirely on MREL, or minimum requirements for own funds and eligible liabilities, I would say it has to come hand in hand. Of course, we need the needed capital, the needed MREL, because without you won't find a real solution. But without addressing impediments to resolvability, even a giant amount of MREL will not solve the problem. So it has to come both. You have already mentioned in your introduction, completing the banking union is a priority for the European Union in the months ahead. And I have to confess, the original proposal from the Commission, you were kind not to mention that, is out of November 2016. Now we are in June 2018, so it's time to come to conclusions. And I think we started with record speed in setting up the banking union, but then we seem to have lost a bit pace, so we now need to come to the finishing line and do another sprint, I hope at least. as the SRB, we welcome the general approach agreed last month by finance ministers on the package, and also the general that now the Parliament has put out its approach. They are not totally compatible, so the trilogue there's a lot of reason for trilogue. But putting an end to the uncertainty of this file and having more clarity, in particular on MREL, is surely a positive step. In that sense, I would hope that the trilogue is now really starting in July as promised, and that we come to at least a political conclusion by the end of this year. This would still mean we are talking about a directive and a regulation, and for all the students here, this is absolutely clear what it means. Directives need to be transposed into national law. So we will have a bit more time to go until this all becomes European law. But clearly, then we will have to, until then, we will work off the current legal framework, keeping in mind possible changes to come, but only adapting to them when they are finally embedded. You can't work off a possible law. So what are we working on? I think for us the most important part is really to get clarity, to have strong, transparent and understandable rules around MREL. And to that extent, like on any compromise, we need to be a bit concerned that the complexity is not getting overwhelming because you add a bit here, you consider a bit here. So I think to keep it transparent and predictable for us is an issue and a tiny bit of a concern for the moment. Integrity of the banking union is the other thing, which means clearly we need internal MREL within the banking groups to be partially pre-positioned within major subsidiaries, but we also need to keep in place that a resolution system needs to work. So if you pre-position all your MREL, you might be very empty-handed at the holding company. That's another topic to be concerned about, or to watch out closely, I would say. So, and as I said, once the trilogues are finished, the package is adopted and transposed, we will have to adapt our policies, the revised legislative framework. So we hope on progress on the risk reduction package will help reaching a compromise and a solution on the common backstop. We have been promised a backstop to the Single Resolution Fund, and I think there is now broad agreement, first of all, that this backstop has to be put in place by the latest by 2024, when the fund is fully built up and mutualized, and hopefully earlier, and that this backstop is most likely to come from the ESM, so the European Stability Mechanism. This, I think, is agreed upon. There are some ideas about that it should be basically a borrowing facility for the SRB in case of need. I hope we'll never ever need it, at least not during my times, and that we will have to make up for these loans then in a time period of 3, maximum 5 years. And as I'm belonging, like hopefully all of you, to the people that believe if you borrow something you have to repay, this also limits the amount we can borrow because the banks need to bring up the money to repay this. So there is still a lot of work to be done, but I hope that there will be a clear mandate to get this done, and to be very mindful here that we are not inventing a second resolution authority. So the backstop needs to be in place if and when we need it, and there can't be additional conditionalities in, because then it's basically not a backstop. So, but however, and I think here I must be clear, and this is the area where we are concerned, not so much an area for politicians, but I would say for us, being the resolution authority, being the central banks, is that we will not solve by itself, with this backstop, the issue of funding, i.e. liquidity in resolution, which needs to be addressed jointly with other authorities. Funding in resolution is a key issue and one of the white spots that remains in our framework. To be clear, the Single Resolution Fund, or the SRB, can contribute to the provision of funding, and I'm now talking about liquidity, not capital support in resolution. However, considering its capacity, it will never ever be large enough, and it has never been designed for being the liquidity provider for large international institutions. And keep in mind, we are the resolution authority for 8 GSIBs Euro area. So while the resolution framework provides for powers, tools, and I think efficient tools to restore the solvency of failing institutions, even if the bank is well capitalized after the resolution weekend, don't expect that it will be easily assessing capital markets for liquidity on Monday. It will take time for confidence to come back. I hope there's a lot of confidence in us, but it will take time. And there needs to be funding to bridge this. Here, further work is required, and developing an effective solution which markets understand, addresses also the risk, and may limit even the need to access such facilities, because markets then know there is a solution. It's a bit the whatever it takes. Be assured there is a solution, so don't test it. So this is, I think, an area where there is clearly more work needed, and my teams are always very nice not to add the word European Central Bank here, because they know about the sensitivities at the European Central Bank, but I think there is a clear role for central banks to play. So political agreement is also needed, and here I fully agree on the European Deposit Insurance Scheme. This is the third pillar of the banking union, and we won't have a true union without also putting deposit guarantee on an international frame. Now you can put in conditions here and conditions there, but you should have a very clear picture of what the ultimate goal should be. And I'm as keen as you to see the outcome of the discussion tomorrow. I think my take would only be, now it's time for economic stability and growth in the euro area. This is the time to continue to push for solutions, and not to say 10 years was enough and now we take a break. So maybe I'm just briefly highlighting some other topics. I know that I'm talking far too long. Insolvency procedures in the EU are still very much, I think they're entirely national. Just the Bank Resolution Directive is an area of European law here. They are not equally structured in all member states, and they should definitely be elevated to a common best standard and practice. Now, the ideal solution would most likely be a Europe-wide insolvency procedure, at least, or similar harmonized procedures for the insolvency of financial institutions. But as long as we don't have that, we are working in trying to really get our arms around 19 different legal systems, and we really urge national governments to move to make sure that their systems are up for the challenges of today. Currently, we are, as I said, faced with 19 different regimes in the banking union, and you can imagine that this makes analyzing insolvency counterfactual, and this is the safeguard in our framework, that no creditor should be left worse than in insolvency, just a bit random. It depends on which country do you have to look at. And I could carry on. So insolvency procedures should be very high on the agenda, and I hope that everyone hears it in Brussels in particular, but also in the member states. Another issue is clearly legacy issues. We are coming out of a financial crisis, and there is still legacy to be addressed by the European banks and by member states. And to be very clear, it is not particular member states it is particular banks in several member states that need to address the topic. We are clearly supporting the efforts of the European Central Bank, of the European Commission to tackle this problem, or to put it very bluntly, if we don't tackle the problem while the economy is growing, we can't tackle it in a downturn, and the next downturn will come at some point. So, to use an English expression, let's make hay while the sun is shining, let's make progress here. And I think I'm perfectly realistic. Coming out of the private practice in my previous life, there has never been a situation where this is making profits. So you at some point have to decide to bear losses in this business. We need definitely to make progress here. Another topic which is high on the agenda, and I think this is particularly high on the agenda in this country, but also, again, in a number of other countries, is how to deal with retail investors. Now, there are some that say retail investors need to be always safeguarded. Let's be fair. I think the Austrian Central Bank did a nice study on that. The average retail investor in banking is not the average citizen. It is rather the upper layer. You need at least to have a bank account and a deposit account with your bank to start to be a retail investor. So for me, it's very clear now turn it the way around. If you come to the resolution of a bank, you have to look in who bears the cost by the hierarchy of claims. So you start with equity, you go into subordinated, then you go into senior, and the like. This is a normal way. You don't decide that you like this class of investors and you don't like that class of investors and therefore separate. But there's also truth in the fact that in the past, investors have not always been fully informed of what they were buying. I'm not saying not always. There were also investors that saw a bigger number than a smaller number on the document. But clearly, there is a big role for market regulators to make sure that investors are fully informed. And there is a need for investor education that normally the fact that you get more interest is not meaning that you take less risk in an investment. So this is not an easy solution. And last but not least, it is a topic which we look in from a resolution perspective in saying, what if you have a large stock of retail investors, or even the customers of the bank being the investors? Is that an obstacle to resolvability? You might not have a happy customer the next day. So there is quite a lot to be considered. But I would warn to say you bluntly solve the problem by saying retail investors should not buy bank bonds. That's not the solution to the topic, just to be blunt here. So, and with that, I would actually stop because I think I've addressed a number of topics, but I would not like to stop without once more thanking Banca d'Italia as the National Resolution Authority for all the work done, and actually also to acknowledge, because that's sometimes going a bit under the radar, for all the work that has been done, in particular around the insolvency regime in Italy, addressing the, I always struggle with the word, senior non-preferred bonds that banks now start to issue. So there is a lot happening. Unfortunately, like in any marathon, until you've reached kilometer 42 point something, the marathon has to go on, and there is still more to be done. So I think the sector in general in Europe, in Italy, has made great progress, but there is still, unfortunately, more work to be done. And I think this is what we want to contribute to, and I'm now looking forward to the discussion, and thanks for your patience in listening to me.
Thank you very much, Ms. Koenig, for your interesting speech and for the important points you have just highlighted. I agree with you that there is a strong need of transparency and clarity for the banking field, and in my opinion, for all directors, and maybe we can discuss about this point during the question time. I'm aware that a lot of questions could be asked Ms. Koenig now, but I just want to remind that we are going to have a question time at the end of all speeches. So it's now time to introduce the second speaker, who is Giorgio Gobbi. As head of the Financial Stability Directorate of the Bank of Italy, he will offer us the perspective of a national supervisory authority. And I think that it is particularly interesting to have the opportunity, after the point of view of a European authority, to listen to the point of view of our national supervisor, that, as you know, has also got resolution powers with regard to not significant banks. So, Mr. Gobbi, the floor is yours.
Thank you very much to the organizer of this special session of the very interesting conference. Thank you to Elena Beccalli, to our chair, for giving me the opportunity to exchange views with such a distinguished panel and a distinguished floor. I work in the Bank of Italy, and I work on financial stability, whatever it does mean. And this I have unfortunately, I have not responsibility on resolution and micro supervision, and I am a lucky under this stage. So I will. Something terrible is happening. Things that I'll give you. We have the title of this session is European Banking Issues, and this year it marks, at least in this part of the Atlantic, 10 years from the starting of the global financial crisis. In the United States, it's marked in 2007, but in Europe, it really started in 2008. And I think that it's fair to say that the European banking industry is still in a flux of change. The dust is still on the air, is not. So we have still many forces are driving this change. First of all, it's not completed the implementation of the post-financial crisis reforms. Still, there is work in progress. There is the completion of the banking union, as Chair Koenig mentioned. There is still a lot of work to do, or at least part of the work to do. And we have something relatively new in this part, at least in continental Europe. That is, we have strong capital markets that are going faster than in the past. That is, our financial systems are becoming more diversified. Still, banks have an important role in that, but less important than in the past. And last, it's not specific to Europe, and Europe is lagging behind on this, but is the process of digitalization. I cannot talk on all of this. I have this. Okay, all of these topics. Otherwise, I will have all the conference, the time of the conference. I just focus on a few issues, okay. I'll just say a few words from my perspective, that is on financial stability and not on having hands-on or on resolution, on the topics touched by the other distinguished speakers, that is the resolution regimes and instruments to deal with banking crisis. I'll spend a bit more time, if I have it, on a brand new set of regulations that was introduced in Europe after the crisis, that is the macroprudential policies. And this is particularly important at this point of the time because the financial cycle is turning in several countries in Europe. So you will have the chance to test if this instrument has some power, some value to tame the financial cycle. Just a few words on non-banking finance and a few words on fintech just to conclude. Let me start with the resolution regimes and instruments. Well, in general, there has been we have a trade here. We are facing a trade-offs, and being in an economics department, trade-offs are bread and butter of economists, and also we have been a change of regimes in the way we face banking crisis, post-crisis, and this is global change of regime, global change of attitude, and we have some specific the way in Europe we have dealt with this change in a specific way, with specific rules and specific instruments. At a global level, we come from a past before crisis, before the crisis of 10 years ago, in which we had some sort of constructive ambiguity, to use a famous catchphrase of it was used in monetary policy, in which that often resulted in ex post stability, but there were costs. Costs concerning moral hazard, so inefficiency, and there was tax concern. It works more or less in the in the western part of the world, in the post-World War II era. It worked more or less efficient, stabilized the banking sector. We didn't experience nothing like the recurrent crisis in the beginning of the centuries in this area. But when the big crisis came, we had enormous costs for the taxpayers during the crisis, and this led to the change in regime. Now there is bail-in and liquidation mandated. The creditors are, first the shareholders, and then the creditors are called to pay the bill, and this is expected to reduce moral hazard, distortion, and the distortion in the market and the taxpayer burden. But there may be still controversy. We have not tested it after real financial shocks. So there may be concern about financial stability on this side. What is if you have that part of the creditors, the bank, are to share the burden of a crisis, and with the bail-in liabilities, here there is a question. We have at the global level, we have the TLAC, that is the global financial institution that already is in place, the regulation, that issue particular kind of liabilities that are to be used in case of resolution to make the banks viable. The resolution will start on Friday evening, and the banks open Monday morning with the new capital, and you use these bail-in liabilities to substitute the capital that has been absorbed by the losses. It's been used to absorb the losses. So who is going to buy in this kind of liabilities? Who are those who will share the burden? Retail customers, well, Chair Koenig has made her point. I think that it may be that some part of the household, some section of the household has can invest in these liabilities, but we must keep in mind that these liabilities are very risky, and to evaluate this kind of risk is very non-linear, and there are conflict of interest between banks and their own and their customer when they are selling this kind of subordinates. So, and unless we are expecting that the concentration of financial wealth will be even more, that financial wealth will be even more unevenly distributed among the population, so there are few rich that can buy a lot of this kind of subordinated, I think that the household sector is hardly the solution. So we have the long-term investors like pension funds and insurance companies. Still, as the past experience shows, that they are looking for equity. Because there is something called risk premium, and in the long run they want to take part of this gain. So it's to be seen if they can be how large can be absorbed this. Well, I exclude banks from the beginning because of the contagion. We can't expect that banks buy other banks, otherwise we'll have a serious problem. So we have investment funds. At the end, we are left with investment funds, but these are the more the kind of investors that in a run they are more they can turn in idiosyncratic crisis into systemic crisis, because through the traditional run schemes and trends. So it's still to be experimented. TLAC is third institution in the world. So when we move to Europe, in which we will have a larger number of institutions imposed REL, here we have still to be to be seen who is going to invest in this. We are expecting now, these numbers, maybe I am a bit obsolete because I'm not in the front line, but more or less I think that the idea cannot be, the real figures cannot be very, very different from that, between 25% of risk-weighted assets. And the shortfalls will be particularly relevant for medium-sized banks. Keeping in mind that medium-sized must be are large banks in the European ranking, but are medium-sized compared to the world ranking. And these kind of banks may have also to have liquidity to ensure the liquidity of this instrument may have been some problem for these banks, there will be an impact, certainly in the cost of funding, because they are more opaque, because they have and this may have a problem. There may be a repercussion on the supply of credit. We had a box in our financial stability report issued on the end of April. So we have with MREL, that is a good idea in principle. In practice, we have still a number of practicalities to be solved. Then we have the rules of the BRRD. We have specific rules that say what is going to happen when we have a resolution. Here we have a trade-off between commitment and flexibility. In principle, what you would like to have rules, a law, that enumerate all the possible cases and leave keeping in mind we are in the European Union, we are not a federal state, so we have our the agencies that are implementing these rules should be remote from taking political decisions. Let us take this way. So in this case, you would like to have very detailed prescriptive rules, but this goes against, you can never have a perfect contract. This is one thing that in these rooms should have been taught and should have been. So you have this kind of compromise you have to strike between having rules prescriptive, but since you cannot forecast all the possible state of the world, you have to keep flexibility in order to meet unexpected events. So this is still, there is work to be done here, and still I think that we are in a learning curve. Let's put it this way. How should we strike the balance between these two requirements that we have in a set of rules? Last, and here Ms. Koenig already was very clear about it, this, in Europe we don't have insolvency procedure, because it's true that bank failure is insolvency as in banking industry, as in other industry, but banks are still special in some way, otherwise it's difficult to explain my salary. And and if we have not some sort of specificity in the banking, and I hope that my salary is of there is some counterpart to my salary. So I think that, and there are a number of reasons why banks are special. So we need to increase, we need an insolvency procedure specific for banks that can increase the efficiency of the liquidation. The atomistic liquidation is really it's difficult to envisage an atomistic liquidation as an efficient outcome. I was talking with my colleagues at the Fed. I was asking them, the FDCAI that manage this insolvency in the United States, but how many atomistic liquidation procedure have you had not in the United States? And they told me, I am not aware of one existing. Maybe it was not competent in the issue, but it's a very rare event, let us say. So we need to do something. And we need to reduce the costs of retail creditors, because we have to bear in mind that among the creditors of banks, there are the small business. And small business put their money in the bank not just because a saver or investor, just because the banks do the management of their liquidity needs. So I think that this is an issue. Small businesses are not covered by the deposit insurance, and still And also, you have to guarantee the provision of financial services to local communities. It may be that a bank is not systemic in the sense that it goes under resolution, but it may be very important for, and this is the case of the two regional banks that were liquidated just 1 year ago in Italy. So I think that if we want to preserve financial stability, but also if we want to make the new bail-in regime politically sustainable, we have to face the problem of what we do with the medium-sized and small banks that are not protected by the resolution scheme. And this is what Restoy at the BIS said, that there is the middle class problem, the kind of banks that are middle class that will be extremely costly to liquidate them, but they are not covered by the resolution procedures. So let me skip to other few more things that I pretend to have some more competencies. The financial cycle. This is the measure that it was enshrined in the Basel regulation of the stance of the financial cycle in Europe. That is a credit to GDP gap. It is the distance of the stock of credit to the economy from the long, as a ratio of GDP from its long run average. And what we start to see is that for a number of countries now this gap is positive. Not very large. The figure is a bit outdated, but the new figures will be released soon, and I didn't want to spoil the SRB figures. But we have a few countries that are above zero. You have a number of countries that are still below zero, but a few countries above zero, and means that we have to monitor this development of credit. Well, the rationale of this is that credit bubbles have been at the root of most episodes of financial crisis and instability. So now we have a new set of rules to try to avoid that credit bubbles build up in the economy. Among the countries, as not small countries in which the credit to GDP is positive, there is France, and France has announced that it will take measure to tackle these things. This is a completely set of new instruments. Well, central bank supervisors have always in the past dealt trying to tame the financial cycle, but think of in the case of Spain, that you have this kind of provisioning, dynamic provision. But now, the way in which we can do this is enshrined in the European legislation. We have a number of instruments we can do this, but up to now, the most conspicuous of this instrument is the countercyclical capital buffer that says that when the credit to GDP gap or other indicators of financial eating are building up, you have to to put a buffer on the capital, rise the buffer. It's not a micro prudential instrument because it is applied over the board to all banks that work in that jurisdiction. The point is that up to now we have used this instrument in a rather experimental way, but it was not serious. Let's put it this way: because we have not a financial cycle we are both in the descending phase of the financial cycle. Now we are in the upward curve, and we start to think if this is one thing that it can work. Here, really, we have in uncharted territories, but we will expect that after France, other countries will start to announce that now we have some announced to rise this capital buffer, and this will, in a sense, put a ceiling on the kind of activity that the World Bank can do and can perform. It's a new thing with respect in the past. We don't really know how effective it is, because if you put it in our macroeconomic models, it works. But again, when we go to the practical level, things usually turn out more nasty. And also what we don't know is the side effect of this policy. We have Ireland is a particular case because we start to experimenting before and using specific tools to tackle the problem of the real estate, because banks are very exposed to the real estate market, and price in the real estate, residential real estate market then going up. So they start to put ceiling to the amount that households can borrow. It has worked to curb this kind of risks, but banks have shifted their portfolio toward other kind of risks. So it's still we are starting to experiment some new field, and I think that it's worthwhile to keep an eye on that. Moving on non-banking finance, I was telling this is the global picture, and it's mixed banks and asset management companies. What we see, since it's the red bar is the size of asset management companies, and banks are not the largest players, no more the largest player in the financial industry. This is also starting to become true in Europe, at least in the way in which the corporate sector is financing. And we see that during the past decades, the share of bank loans on the liabilities of the the corporate sector of non-financial corporation is declining steadily. So one was in the past one source of revenues and of risk, certainly for the banking sector, is it was the lending to business firms is becoming less important, and there is a stronger competition from the market also in Europe. This is changing. This is changing the way in which banks make their business. They have their revenue, the flow of their revenues, and this maybe lead to. There are several issues. First, what will bank do? Second, what will regulators and supervisors should do? If we have we can control, we have experience and we can control the risks in the banks, well, we should have experience and we should control the risk rating of banks. We really have less experience how to manage the risks that build up in the other financial in the other part of the financial system. So this is a challenging world. A more diversified financial landscape is positive, but it also poses challenges. First to banks, that they have to reinvent their business model, and then also to regulator and supervisor. I use my last 3 minutes to say something about fintech. Fintech is a very popular term. If you Google, there is the Google Impact Index or something like that. And what is really interesting, for example, for the impact index of artificial intelligence is now declining, because it's very difficult to implement this kind of new technologies usually in firms, in ordinary firms, because of a number of complexity. Fintech is still growing fast, the popularity index. And something is happening. Is happening in the core business of the banks, that is lending. We thought that fintech could attack investment activity, investment management. We could attack a number of activity, at least in Europe. These are small numbers in terms of lending. But they are, and if you exclude UK, in which the industry is already developing fast, but it's growing very fast. So if I use this and not other, the payments are already very well. The fintech is already well developed, but here's the core business of banks. That is where we are also supposing that banks had a comparative advantage with respect to the other firms in the financial industry. And also banks are reacting, investing. These are the Italian banks. It's not a representative sample of Europe, because Italian banks are lagging behind. The number is the spending in IT technology. The number are small, but are also increasing very, very fast. So there is something to say, something that is changing, both in the industry and in the way in which the banks organize the organization within banks, and this is going to have huge change in the future years, have a huge impact of this. So, and this poses a number of issues. One is that the role of the interplay between banks and the large giant of the let me say, the part of the economies that has already developed the digital technology. And we have also information asymmetries that may create huge, important advantages, competitive advantages for banks, but we don't know how they will develop in the future. And the business of banks is going to change, and is also going to change the business of our side, because there are new risks for financial stability, new types of interconnection through the tech services providers. There are usually the question that is posing from the Financial Stability Board and all the regulator and supervisor authority are posing is that, are we prepared from that? Usually, and this is again against my salary, there are too many economists and too few computer scientists within the central banks and the regulators, and unfortunately I'm an economist. And still, it's not clear what was the role of policymakers. Should we try to protect the incumbent for a reason of financial stability, or should we open the market for the sake of efficiency? This is a still difficult trade-off. I think that it's unclear now where we should strike a balance. I think that I have exhausted my time. I thank you very much for the patience of me, and thank you again.
Many thanks, Mr. Gobbi. Your broad presentation has dealt with many aspects particularly relevant to us. Personally, I have much appreciated the final remarks on the impact of digital innovation on the future of the financial sector, also because as Università Cattolica we are involved in the European FinTech Regulation Expert Group that will help the European Commission to develop a proposal for the future regulatory strategy in respect of FinTech. And in my opinion, it's really crucial and not easy to find a balanced regulatory approach. A regulatory approach capable not to hinder innovation, but also to protect traditional interests in the banking field, financial stability, investors' interests, and in a level playing field perspective. So it's a very important topic, in my opinion, a very important European banking issue. Now it's time to listen to the point of view of the banks that are the effective actors on the stage we are speaking about. And to do so, we have with us Pierpaolo Montana, Chief Risk Officer at Mediobanca. Mr. Montana, the floor is yours. No. Okay.
Very much. So, first of all, I would like to thank the organizer for their kind invite to attend this panel on European banking issues, a large topic indeed. Quite vast. So, the topics I would like to touch upon this brief speech is a sort of navigation positioning for banks in Europe, more specifically. So, where do we stand? I will mention a few facts. It's not an academic presentation, of course, but we'll have some anecdotal view and a practitioner point of view. Where do we stand? Which are the main issues? So let's see from an economy point of view are the news. And the news are not bad since current issue of the economists you can read the Eurozone 5 years into an economic upswing. We are used to talk about the crisis. We are celebrating the anniversary of the crisis, 10 or 11 years, but we haven't been 11 years in a crisis. Let's see some elements of this momentum. The GDP growth in the European Union has been 2.5% in 2017, and 2.4% in the Eurozone. Both cases, this has been the higher growth since 2007. In 2017, furthermore, the growth is even more evenly distributed across the country than it was before. The growth is in Germany, the growth is in the Northern Europe, but the growth is also in Spain, the growth is in Italy. Main drivers of growth have been, admittedly, the international trade. So the 9 macroeconomic conditions around the world had a positive drag on the European economy. But to some extent, to a lesser, but to some extent, also the consumer demand. What is maybe lagging is the investment component of the GDP. The aggregate levels in the Eurozone are still below the crisis levels and are not forecasted to pass this threshold until 2019. Let's move to unemployment figures. This is maybe the most painful figure in Europe, the most painful economic aspects in Europe. The unemployment at the end of 2017 stood at 7.6% in the European 8 countries and 9.1% in the Eurozone. These levels are, I can say that are positive. They require further efforts to reduce them. But in both cases, these are the lowest levels since 2008. In case of unemployment, contrary to the GDP, we still have a distribution problem of the unemployment level, both across different countries and also across different cohorts of the population. Youth unemployment in the southern countries is still a major issue. Let's move to another aspect of, say, the economic wealth of the euro area, the trade balance. The trade balance of the euro area is significant. Admittedly, the trade balance figure shows some dispersion across the Eurozone. We have countries with significant surpluses, Germany, but also Italy, the Netherlands, and we have countries with substantial deficits like France and Spain. Again, it's interesting that the distribution of the plus and the minus is performance in this regard. I would say in Europe, there's no clear divide between North and South in terms of trade deficits. Contrary to China, the Eurozone current account balance is higher than trade balance, with somehow a more balanced distribution across countries. Figures go from plus 7.9% of GDP for Germany and plus 2.79% of GDP for Italy to minus 1 for France, with an overall balance of plus 3.2% of GDP for the whole Eurozone. So, the other aspect that we discuss frequently in Europe are public finance, how public finance are going. The overall government budget balance as percentage of the GDP is minus 0.8% for the Eurozone. This goes from minus 2.4% for France to a positive, so a budget surplus for Germany equal to plus 1.1% of GDP. With a not excessive degree of variation across country, Italy stands at minus 2% of GDP. Overall, the real economy is not doing bad. Monetary policy conditions. Monetary policy conditions are benign and are set to stay benign for some time. Yes, recently we had the announcement, the conclusion of the ECB balance sheet expansion, but this conclusion of the balance sheet expansion doesn't imply per se a quick reduction of the stock. So this doesn't mean that we will go quickly to the monetary conditions we had before the crisis, before 2007. It will take some time, years, maybe a decade, to decrease the size of the balance sheet of central banks worldwide. Of course, there are risks to this scenario. In particular, for the monetary policy, there is the risk, but it's not the central scenario, of a consistent core price growth on inflation that, of course, will change the interest rate perspective, the interest rate trend perspective. So overall, we say that the macroeconomic scenario is not devoid of risk and uncertainties, but it has evident positive conditions, and overall, this should be at least moderately positive for banks. But now we have to look to another element. I will try to bring your attention to another element. This is the figures right now. What has been the path of the different countries across the crisis? So the current increased similarity of general economic condition across the Eurozone country doesn't mean that we had a similar path. Actually, the path of the different countries through the crisis have been quite different. The time to reach the pre-crisis GDP levels have been very different. And, for instance, Italy and Greece are still below the 2007 level of GDP. This will have consequences. This has consequences for the banks, of course. So if we turn to credit markets have been debtor market for some time now. Offer of credit is abundant, I will say. We just saw an interesting graphical representation on this in the last presentation of Mr. Gobbi. The offer of credit is there. If we remind that the investment level are not yet at the level of pre-crisis, we can see why the general spread level have been steadily declining in the last years. What we have in this situation? Well, of course, when you have an expansion of the credit volumes, a demand of credit that is there but is not as buoyant as it used to be, we have the risk of softening the lending standards and relaxing the pricing condition. And these are risks not to be dismissed. Of course, the point is not the monetary policy per se. I mean, we do lending, we do banking in every monetary condition. We do lending in low interest rate environments, we do lending in high interest rate environments, but rather is the typical credit cycle phenomena. The usual sequence of saturation of best obligors credit requirement, the search for new customers, the decrease of standards, the incorporation of positive trends elements into the through the cycle modeling. So we assume that what we have been observing in the last 5-6 years is representative of the next 20 years. As this has been summarized by a famous book, the famous "This time is different" quote. So I would say macroeconomic condition relatively or mildly favorable to banks. Credit market condition in general have not been favorable to banking intermediation. The decrease in credit spread has been more pronounced for the customers of the banks than for the funding needs. One of the points that I see in the current European banking system, but this point is, I would say, applies differently to the different geographies. So on one side, why we have this difference in spread trends in different geographies. On one side, we have a common currency. We have a common lender of last resort. We have, since 2014, November, a common supervisor. We have a common resolution authority. But rating agencies still apply different and national sovereign rating caps to banks. On the other side, the Eurozone market for bank lending have proved to be more homogeneous than the corresponding market for bank funding. The spread of a BBB plus corporate in Europe is more or less less influenced by the nationality of the corporate, is more influenced by the rating, while for banks, the significance of the location of the bank, the nationality of the bank, is still higher. So maybe is the most problematic aspects in terms of macro condition. Let me now come back to the title of this panel. So, European banking issue. And I'd like to give you a different type of anecdotal evidence, not numbers, but just some experience I had talking in similar conferences in different countries. When it happened to me to take part in the European Banking Conference in Germany, the focal point of discussion was bank profitability and low interest rates. Recent similar conference in Italy, the buzzword has been, of course, non-performing loans. Seldom we discuss about the low interest rate in Italy. Seldom I heard talking about non-performing loans in Germany. In France, similar occasion, the conversation focused on regulatory burden, RWA comparability, Basel IV, or we should not call it Basel IV, Basel III finalized achievements. So, and the fact that I'm mentioning these countries is not unrelated to the fact that I've been working in French, Germans, and now Italian banks. So my remark is that apparently the most striking feature of the European banking issues is that we don't have a common European banking issue. We have banking issues that are national. So what can be the common European banking issue we have? Well, to do so, we should not compare our banking system. We should compare the European banking system with what's happening in the United States. So the crisis started. The crisis has developed across the pond, I will say, in the U.S. and in Europe, and with a kind of simultaneity. 2007, we had the first sign of crisis. Someone identifies in Bear Stearns, someone identifies in IKB and West LB, someone identifies in a closure of an hedge fund of BNP Paribas, but it's been quite simultaneous. The development has been quite different, though. If we take some market values, the biggest U.S. bank by market capitalization is way bigger than the biggest European bank by capitalization that happens to be Spanish. I think in this academic conference I like to mention one paper many years ago, a seminal paper many years ago, was different about banks. And no, it was not the salary of the employees. This was not mentioned there. The point now is what's different about European banks? I don't know the answer. I leave this question maybe for the academic audience to develop and make further investigation. But I have some hint. And one hint to me is that this fact that we have a different, very different market behavior of banks, market capitalization, market valuation of the banks in Europe versus the American ones, and that in Europe we focus on different topics locally. To me, this is another evidence of the incompleteness of the evolution of the institutional framework. But we cannot assess this point of view if we focus on the very issues in an isolated way. So we need to talk about low interest rate in Italy. We need to talk about NPL in Germany. We need to talk about the European issues in Europe. So let me spend the next few minutes to mention a few remarks on these topics. I will tend to be European. On NPL, from what I tried to draft earlier as macroeconomic conditions, it is evident that there is a high correlation between the NPL levels and the path of GDP growth in the last 10 years. There's a kind of hysteresis in the NPL stock from the path of GDP. While, of course, this is not the only explanatory variable. The NPL is a highly inhomogeneous asset class, if we want to use an investor terminology. The NPL generated as a result of an asset bubble are very different from the ones generated by a long-term reduction in competitiveness. The ones generated by an asset bubble are quicker to arise and are also more manageable in terms of disposal. The ones generated by long-term reduction of competitiveness are slower to accumulate and more difficult to dispose. The ones generated by asset class bubbles are normal real estates. Real estates, mortgages, real estates, lending. These are more homogeneous, these are easier to deal with. The one generated by industrial crisis means that your counterparty is a living company, is a company that has still investment, still production, still a plan to execute. The current regulatory and supervisory initiatives at European level are very welcome, as they create the condition for tackling the problems and effectively reduce the NPL load in banks' balance sheet. Even though some details, some provision, as for instance the different consideration of repossessed assets versus the NPL, or the non-differentiation between bad loans and unlikely to pay in the category of the NPL, may require more attention. If we come to the comparability of RWA density, again, the supervisory action undertook with the TRIM exercise is very welcome and set the basis of a fair competition. A benchmarking exercise performed by BIS a few years ago showed that one of the causes of the difference in modeling in RWA density in benchmark portfolio modeling was the different supervisory action. So this is something that has been tackled, and we are confident that a more homogeneous approach is there. Finally, on the profitability impact of the low interest rate environment, the remark is that this has impacted very different in different Eurozone countries. So we had the same monetary policy, but this has not impacted the profitability of the banks in the same way, say, in France and in Germany, in Spain and in Italy. Why so? Again, this may be a question for the audience. My hint is that most likely this is due to different banking industry structures, in particular cost basis and efficiency. These aspects definitely may require further investigation, but if we take the total market capitalization of German banks, we see that this is much lower than corresponding French or Spanish banks. So where do we stand now? I would say that in terms of risk reduction, a great deal of work has been completed. Banks are better capitalized. The NPL have been reduced quickly in countries, Ireland and Spain, where they've been originated by asset bubbles. More gradually, but decisively in countries where it depends on competitiveness, like Italy or Greece. In terms of efficiency and cost reduction, there are robust actions underway, at least in some countries, both at the individual levels. I think the Italian banking sector has lost 17,000 employees in the last 12 months. So there is a hard work that has been done on the cost reduction and efficiency. Cost reduction is an important part of the risk management of the bank, because we should remind that one of the indicator of the propension of the banks to take risk is the cost-income ratio. Every bank that has a cost-income ratio close to 1 tends to take more risks. So reducing the cost base is equivalent to a risk reduction. Where this process is not yet completed is across aggregation. So there's a lot of action done at individual level, not enough through aggregation. There are aggregation, of course, underway in individual level, country level, but not enough cross-border. And this seems still unlikely anytime soon. So overall, it seems that the most conditions for a first step forward in the creation of the banking union have been fulfilled. It is quite timely, this panel, as some decisions are under discussion in these days, so we can still express some wishes today, because the decision has not been taken yet. In this regard, I came to conclusion I welcome the statement of the SSM chair about the sufficient progress that has been done on legacy risk reduction. And also, I welcome now the same view from the SRB chair. Hopefully, this may be complemented on a reduction of national risk ring fencing and capital and liquidity in the Eurozone, because this may be one of the main elements to prevent a cross-border consolidation. Thank you for the attention.
Thank you, Mr. Montana, for your interesting and broad macroeconomic pictures and also for your final proposals and suggestions. Now, it's time to give the floor to our last speaker, Giovanni Pepe, partner KPMG. I think that he will offer us his perspective on the situation of the banking industry at European and then the Italian level. The floor is yours.
Okay, if we can move the microphone. I'm staying here. Oh, that's perfect. Let's go. The telephone is not needed now. Okay, thank you so much. I had my thanking to the ones of the previous panelists, and so let's go directly to the topic. And the topic is somehow represented by this nice slice of cake. The thought I want to provoke somehow is do we have too much of a good thing? And the good thing in this context is the banking regulation, just to be, clear. Okay, I'm remembering what were the problems we wanted to address when the re-regulation trip started back in 2009. In the aftermath of the great financial crisis. Without going deep into these, into each and every of these boxes, basically we can limit ourselves to remember that we, at the beginning of the crisis, we had an issue with asset price appreciation. This is sort of regular things for all banking crises. On the run-up to the great financial crisis, featured an asset credit boom with real estate assets, being the core of this boom. We had then a specific feature of the crisis, which consisted in having complex products and opaque products whose returns rely on continued favorable economic conditions. And when the crisis hit the economy, obviously these products behaved in an unpredicted, who knows whether unpredictable or not, but unpredicted way, hitting the holders of these financial products. With banks being too much leveraged, this caused a problem. This created problems to banks, and very much connected was the fact that the overall economy was way too leveraged. Also households, specifically in certain countries, first and foremost the US, the households were too leveraged, or at least much more leveraged than in the past, because of the credit expansion that ignited the crisis. Interconnectedness was another sort of new thing. We became aware of a bundle of connection links that put together all financial institutions, and these, was not recognized, or at least not very well recognized in advance. And this is very much linked to the famous too big to fail problem. We soon realized that when the largest banks got hit by the consequences of wrong decisions taken before the crisis hit, it became clear that letting them fail was not an option, because the financial system was not prepared to such events. Okay, so what did we do in order to address these problems? We revised the prudential regulation, going pretty deep. We started with Basel 2.5. Now we have Basel 3. Regulators don't like to speak about Basel 4, but actually it is Basel 4. Because number of things will change, and these are not small things. We introduced what Giorgio Gobbi mentioned before, the macroprudential levers, in order to avoid the repetition of these of the problems we experienced with the great financial crisis. We introduced what Mrs. Koenig mentioned, and also Gobbi discussed these specific liabilities made on purpose to be sure that specific creditors will be hit by the crisis of the relevant banks when these unfortunately happen, because from time to time banks go down. We tried to address the problems of complex and opaque instruments into the balance sheets of banks with the fundamental review of the trading book, with the new securitization framework. We tried to curb the incentives of banks managers by introducing a scheme for compensation for bank managers. We also, wanted the accounting standards to evolve, to become more forward-looking, whereas the previous ones were not sufficiently. And also, last but not least, the overall marketplace for derivatives changed. Okay. Then, at the end of this, pretty long trip, where we ended up? We ended up in a fairly complicated place. Then this slide is not so easy to be seen, I guess, from the audience. But on the message the slide, is aimed to convey is the complexity. Nowadays, banks have to deal with really a range of ratios. And what they do, I mean, in reality, is try to optimize against these ratios, trying to do their businesses while being in line with all these ratios. Just to mention, we have a number of ratios for solvency risk, where the solvency ratio constrains risk exposure, the capital conservation buffer constraints banks' discretionary distribution, the counter-cyclical buffer that Giorgio mentioned before constrains credit growth that results in an unacceptable build-up of systematic risk. This is what, for instance, France is thinking to do, to introduce right now. Giorgio told us the ratios for GSIBs increase the loss absorbing capacity of systemically important banks. Okay, and on and on and on. I mean, we have a number of ratios. Then, in order to address a specific gap of the prudential regulation, and this is, in my opinion at least, this has been a wise decision. I mean, certain liquidity risks ratios have been introduced, the liquidity coverage ratio, the net stable funding ratio. You have to know, and we all know that at least the ones of us that deal with European banks or work in Europe, that this trip in Europe took a specific feature, because the setup of the banking union overlapped with the advent of the new global regulation. And when establishing its own operating practice, each of the three authorities here depicted issued new rules and operational instructions. This is natural. This is not their fault. There is no one to be blamed here. It is just, the way things go in reality. So here I have just mentioned, number of initiatives, but just a few number of initiatives that each of these three authorities launched. For instance, when it comes to the single supervisory mechanism, whose fulcrum is represented by the ECB. We have the NPL calendar provisioning, on which we go at the end of my presentation. But also the ECB launched the TRIM, which is an acronym that stands for Targeted Review of Internal Models. So it's a very, very overarching project that consists in reviewing all the models that European banks deploy to compute the capital requirements. On the single resolution mechanism, asked banks to prepare their resolution plans, and obviously, we'll soon launch the MREL instructions. MREL is the European counterparty, the European version for TLAC. EBA that existed before the banking union, but had to find its sort of new mandate within the banking union. Became the fulcrum for the EU-wide stress biannual stress test, and also issued a large number of instructions on the internal models, and also on the accounting standards, with the IFRS 9 being the most relevant ones. So basically tons of additional regulations that add to the regulation coming from the international bodies. Okay, and in the meanwhile, what happened to the banking industry? Basically, these three charts three elements that I have in this slide say altogether that the banking industry is really struggling to cope with the current situation. We start with the chart on the left-hand side. This chart is, basically says that the spread between the 3-year expected return on equity and cost of equity of European banks is negative for practically all European banks apart from UK. Europe as a whole is very much conditioned by UK banks because, they are pretty large. But if we focus, for instance, on Italy, we see that in 2016, 2017, and 2018, Italian banks are not delivering the profits they were expected to deliver by their investors. So they are burning money. But this is not, only for Italian banks. Obviously, Italian banks are, somehow worse positioned, but this is also for other important countries. This is very much represented by, in a synthetic way, by the chart that I have reported here on the upper end part of the right hand, on the upper right. You see that the price-to-book ratio in the United States, is around 1, whereas in the euro area, the price-to-book ratio, which is a sort of synthetic indicator of whether a bank or a banking system is delivering the profits it is expected to deliver, is around 50% in the euro area. So, pretty low. And the reason is clear. If you go down, you see, for instance, that in Italy, the cumulative net income from 2008 to 2016 of the banking sector is minus 36 billion of euro. If you compare this figure with what the insurance sector has generated over the same period of time, you see plus 26 billion of euro. Please bear in mind that these figures now do not take into account the public support that certain banking systems enjoyed and received. Obviously, the figures would be very different if we computed also the public sector support. So, is the regulation the sole culprit of these difficulties that the banking systems, the European banking system, are facing? No, obviously the regulation is not the sole culprit. The economy, is the driving force, as Pierpaolo Montana was saying. There is a strict relationship between NPL and GDP growth, and this can be seen clearly, in this chart on the left-hand side. Here, what I did, I compared the monetary union, the European Union as in its larger version, and the United States. In terms of non-performing loans, you see that, for instance, back in 2009, these three bunch of countries were more or less on same ground. The U.S. economy performed much better. These allowed banks to get rid of non-performing loans, and U.S. banks are now with sort of relatively minimal amount of non-performing loans, whereas European Union banks are still dealing, and we in Italy know very well, they are still dealing with non-performing loans. On the other hand side, we have an issue of bank capital to asset ratio. Seen from that perspective, as we practitioners know, U.S. banks are much more capitalized than European banks, generally speaking. So the key challenge for European banks is how to get rid of existing NPLs, controlling potential new NPLs, and at the same time boosting profitability. If we focus on Italian banks for a while, my perception, my impression, these two charts are taken from the Financial Stability Report of the Bank of Italy. My perception is that the situation is such meaning pretty weak, that we have to be very, very careful. What do these charts is the following things. we start with return on equity in 2016 to see what happened in 2017. On the left-hand side, you see what happened in the euro area significant banks. This is taken from the financial stability review of the European Central Bank, whereas the one on the right-hand side is taken from the financial stability report. Okay, the European banks started with meager, return on equity, but still positive, 3.4%, to reach, an increase till to 6%. And this increase is largely explained by reduction in terms of loan loss provision at the end of the story. If we focus on Italian banks, we start with a very negative return on equity, close to -6%. We reach a meager 4%, and it is largely due to reduction in loan loss provision. So for sure there is a room for cost cutting because operating expenses explain the reduction of operating expenses explains 2 percentage points of this change, but there is still room for cost cutting. Although areas crucial for investments are needed, these are areas that are key for stability and success as risk management and IT. But the situation of banks is such, and specifically Italian banks, is such that regulatory changes tend to weigh more than elsewhere. For instance, if we look at the impacts of a number of the changes that I anticipated at the beginning of my presentation, we see that these changes in Italy tend to weigh more. For instance, we start with the IFRS 9, the amount of the impact of the introduction of IFRS 9. Here the computations are made in terms of bips, of CET1 bips. This is the usual metric for seeing the impact of regulatory changes on banks. So, 50 basis point, up to 50 basis point for Italian banks. Then we have the NPE addendum. The NPE addendum, the cost, the bill for Italian banks is expected to be 2-3 times what is the bill for European banks. Then we have a number of regulatory changes. Basel IV, TRIM expectation, still unknown because depends very much on the business model of each and every bank. The total impact range is expected to be from 30 to 80 basis points on European banks that become 100 basis points for Italian banks. Then I go to the last of my slides where I want to attract your attention to what these regulatory changes mean actually for Italian banks. I could have selected one of these measures introducced recently by the European authorities. For instance, Giorgio talked about the cost, the expected cost of TLAC introduction. This is another form of cost. This is the cost of the NPE addendum. As you may know, the NPE addendum says a very meaningful thing. When you have a loan that defaulted, you have to write down this loan over a certain and fixed period of time, no matter which are your expectations in terms of recovery. Once you reach the maximum level of the end of this period of time, the loan must be written down to zero. These two lines, the blue line depicts what happened in the pre-regulatory change, and the red line depicts what happens in the post-regulatory changes. The area between these two lines is the cost of this regulation for banks. Here the story is the following one: a corporate loan originated with 2% PD and an LGD 28%. Overall, 10 years duration. Then at a certain point in time, the loan goes 30 days past due, and the end of the second year is classified as stage 2. This is a classification relevant for IFRS 9. Then the PD going up to 6%. This means that because of the IFRS 9 regulation, the bank has to set a specific loan loss provision. Then the loan goes on to more than 90 days past due, so it becomes a defaulted loan. And at the end of the third year, is classified as UTP, unlikely to pay. Then the loan, go on and is classified as sofferenze at year 6 and recovered, taking into account its LGD at year 10. The NPL addendum doesn't care about the expected LGD, so the bank, to be in line with the addendum, has to write down the loan to 0 at the end of the 7th year after default. This basically means that the Italian banks are expected to make a huge amount of additional provisions that will impact the expected profits and will make the life of these banks even more difficult. And the gap in terms of credit to GDP gap, that George showed before, to me is at least partially explained by this. So, this is the reason for which I named my presentation a bit too much, or definitely too much of a good thing. This is the question I leave you with. Thank you.
Thank you, Mr. Pepe. With your speech, we have been invited to reflect on the consequences of an over-regulation, and I fully agree with your conclusions. We need rules, but too many rules don't work well. So we have to reflect about it. Now we are a little bit late with our agenda. I don't know if we have time for questions. Maybe only one or two. I don't know. I ask, okay, 2 questions. So, if possible to come here. 3.
I'd like to thank the panel for pointing out how dangerous the European banking situation is. And the danger seems to be we've got too much debt. And has any member of the panel studied what the practitioners did 85 years ago, creating local currencies without debt? And because that would be a way of getting out of the crisis. At the moment, money is not fit for purpose. You can't create money without debt, but the practitioners found a way of doing that 85 years ago. Have any of you studied that, and would that be applicable today to get out of this dangerous situation?
Maybe it's better to collect all the questions because
I'm Luca, I'm a PhD student at Catholic University. I have 2 very quickly questions. Do you think that a credible and rigorous resolution framework could be sufficient to mitigate the bank's incentive to take excessive risk, such that the ex-ante capital requirement and, in general, all the micro-potential standard could be relaxed and simplified? And the second question is, do you think that it is possible to extend the protection of Article 44 of Bank Recovery Reconstruction Directive to all retail investors? A protection not only for some categories of debt instruments, but also for some category of investors.
Thank you. The last one? Okay, the floor again to the speakers.
Probably easier this way. I leave your first question, which I find a very interesting one, to the central banker. this is a question that clearly has to be addressed by a central banker because it's a hot topic. I'm not sure that there's a simple answer. On your second one, and it goes a bit also to your comment, I'm firmly believing in a market economy. So we are not in a business to make each and every bank for eternity surviving. This should not be, because that would basically kill a normal market economy which has entrants and also entities leaving the market. But I would dearly believe that the framework we are having, plus the institutions, in particular the European institution supervisory mechanism, should be in a position to monitor risk and to act and to detect any unneeded upbuild of risk. But I would also at the same time say we need to be mindful. We have been exchanging a bit on this. Do we have too many regulation? I don't know, but we have definitely issued an avalanche of regulation, and we should now take stock of implementing it and then assessing the risk, and to avoid a bit this feeling you've implemented, you have put in place a regulation, you forget that it is only taking effect over the next 5 years, and you start to change it before it even has taken effect. So I think though on the public sector, on the side of those that say let's slow down, we don't need new regulation, we need to implement it, and then we might have to fine-tune the one or the other. But to take risk out of the system entirely doesn't fly. So, and on your second question, to expand Article 44 or to expand the safeguards to all investors, I'm not sure that I believe in this. I think we are all in an area where, going back to my initial comment, we need to be transparent, and investors are allowed to take risks and to bear the consequences. They should not be taken for a ride in pretending that there is no risk, but they should also not be put in a position where if it goes nice, the profit is for the investor, and if it goes wrong, the cost is for the public. So I would not go far beyond. There needs to be always a safeguard, but there needs also to be the allowance for risk. And just one sentence to retail investors. Well, if you're allowed to invest in shares, a subordinated instrument has at least the shares as a buffer before the subordinated instrument gets great. So you need to think about what you want to avoid.
Thank you. The nastiest bit remains at the national level. So this is your question. I will not address your question straight because it's difficult, but I just put in a different perspective. And I take your question as Europe and the European Authority addressed properly the legacy issue of the crisis. I think that it's a different way to pose this. I would say only partially. We were not prepared in 2008 to face because the institutions, there were many holes, gaps in the institutional framework of Europe. A lot has been done, and when the second crisis in Europe, that was the sovereign debt crisis, arrived, still here we are much slower and difficult to address. So with the insight, that insight is a science, very, very precise science, can give a result. With insight, I say, yes, we could have done more to address the legacy issues before introducing most of the new regulation that Giovanni has listed in the. So we hope that in the future we will have a more safe, stable financial sector, and this is maybe we are heading to that. We also hope to have a useful financial banking sector. Thank you.
Okay. Let me thank once again all our speakers, the organizers, and also all the participants for being here today.